Welcome to our continuing discussion on deferred taxes. In this pencast, we're going to look at how to work permanent differences into accounting for income taxes. I'm going to use out of our textbook brief exercise 16.8. If you want to track with that, it's on page 984, but I'm also going to reproduce it right here for your viewing entertainment. In that example, they want to look at a permanent difference along with a temporary difference. Let's do our reconciliation. You should never start a journal entry until you have recognized or reconciled accounting income with taxable income. And in this example, the accounting income that is given is $300 million. And there is a permanent difference that they give us. And the permanent difference relates to a life insurance premium on an officer. I just made that up. The life insurance premium that you cannot proceeds from a life insurance policy on an officer. Guy died. It was tragic. Plane crashed. Sorry. All right. You don't have to pay taxes on that income. It's a permanent difference. You will never have to pay taxes on that income. So we're going to take it off the top. Your accounting income on the income statement will be $3 million, but we're going to start our reconciliation with $276 million. And then we have one timing difference, again relating to depreciation in the amount of $18 million. You don't get to take that on your tax return this time. We're going to pull it off. So your taxable income is going to be $258. How would we make a journal entry for this? Well, 40% of your taxable income is going to be the taxes you pay, and that will be 103.2. You'll have this future taxable item out here in the amount of 18. It's also got a 40% rate on it. 40% of that would be 7.2. Let's assume you have no beginning balance, so you just need to record that as a future taxable item. 7.2, that's what you need for your journal entry, and we will completely ignore this in the creation of our entry. You'll have tax expense. We'll let that sit for a minute. A deferred tax liability in the amount of 7.2. Taxes payable, always tying to taxable income, 103.2. And the sum of those two is 110.4. The sum of these two is used to calculate your tax expense. I did an interim step right here, though. This number isn't accounting income, 300 is, but this is the amount that tax expense will tie to. You won't see it anywhere on the income statement, but accounting students like things to tie. If you take the 276 and times that by 40%, you'll see that that is your 110.4 million. How would that look on your income statement? Well, you would have all of your revenues listed and all of your expenses taken out. You would get down to a number called taxable income. And the taxable income would be 300 million. Then you would come in with the tax expense. And the tax expense is from right here, 110.4. And your net income would be the difference. 300 minus 110.4 is 190.6. I wonder how my math was there. Let's assume it was good. So it is literally what your tax expense is going to look like on your income statement when we come up with this number. Then you'll have a deferred tax liability sitting on your books, and this amount. and taxes payable of this amount. That will go to zero because you pay it every year, or at least you better be paying it every year. So the deferred tax liability is the only number carrying forward. That gives you an example of a permanent difference. Thanks for joining me.